That's that big NASDAQ, to SPX ratio chart that I have just kept on very, very firmly since fall of 2021. And the rollover, NASDAQ underperformance through 2022, and then massive intervention. We're talking massive intervention globally through that coordinated, October, September timeframe. Anyway, this kicked off very much the January effect and the bank bailout, and here we are. So literally on that 2 weeks ago, I mentioned this was, the major bouncer trounce area, and we have on this indicator gone right up into a trend line. We get above, and it will be very, very strong impulse higher in NASDAQ, and other breadth plays will come into play, right? Other stocks will actually get excited about that too, and we'll have a bounce. The question is how strong.
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDucTrading founder, Samantha LaDuc. For more information about Edge, visit www.LaDucTrading.com/edge.
That's what we're talking about right now, right? The kind of the Santa rally, the FOMO that usually kicks in, and seasonality. So we have lots of reasons why folks are excited about this bullish backdrop into end of year. Now give us the bear case, because we haven't actually broken out. Today we got firmly rejected, and it makes sense. Logically, 9 straight days of green up in NASDAQ, and then it pauses, and then it digests, then it rolls over. But this is really, the question I'm asking you for a bearish view into year end, when everybody, is positioning to not miss this 1999, great explosion higher, or whatever they call it.
Yeah.
So talk about the bearish case, because I think the bullish case is pretty well established.
I think that I think the market would be most concerned about a resurgence of yields moving higher. And so the question is, how do yields move higher from here, in light of the most recent data from the Treasury on the refunding and supply. And so I think in order to get bond yields up into the end of the year, you would need to see higher than expected inflation prints.
Fair enough.
I think if we were to get now, look, oil dropping, as it has, may make it difficult for yields to move materially higher. So if somehow oil finds a floor and rallies back a little bit, and then yields go, I think that would be a problem for markets, because we've seen whether it was last year or in the third quarter of this year, the broad markets, not forget IWMs or cyclical, the broad markets seem to struggle most when yields are moving higher at an accelerating. And so the only way to get that would be, I think, with hotter than expected inflation prints that kind of let people to believe, oh, wait a minute, we're very wrong here on Fed. The Fed's likely going to have to raise in December, and maybe even the dots will suggest, no cuts for next year. That would scare, I think that would scare people and say, shoot, they're really going to have to cause a much bigger recession in 2024. And I need to kind of start getting out of equities now. I think that on the flip side, if we got a cool inflation print and continue to get worse than expected growth data that rallied bonds, I think the market would still probably buy the big cap tech stocks into year end. And then we would walk in January where people started to worry about recession. So I think that's the setup for me. I mean, look, can CAC run from now into the end of the year unabated? Maybe it's possible. But I think if inflation is hot, it won't. And I think if inflation is cool, it might. But then we'll start to hear more about growth slowdown, concerns, recession, and that's going to have to start getting priced in. Does that get priced in December, or does it get priced in January? Hard to know. I'll have to kind of watch as we go, but we know that the flows and the hedge buybacks are strong, and we know why there's a Santa Claus rally. And so we might have to wait for January to start trading that recession.
But they're going to front run it. They won't wait until January. So there will be I think just lots of opportunity for both directions.
Yeah, I think it's also interesting that there's for for these big cap tech stock, the biggest open interest lines are January, because that's when the leaps are. So, if you think about just, position pinning and flows, often why the market starts the year, stronger than expected as some of those buybacks on hedges and whatnot, for those big cap tech stocks last, into January. But look, that might be when we start to get, a much more protracted down move in tech is, early next year, unless we get a hot inflation print, which throws the bond market back into disarray.
Watch the full episode and subscribe to LaDuc Trading YouTube channel for more macro to micro videos and other content.